It's impossible to know the future. But if things slow down, it helps to be prepared. This is Money Talks.
All right, we're back to Money Talks. I'm Troy Harmon here with Bill Lako and Dr. Gene Hensler. Bill, you're telling me that you don't want to buy a Treasury right now, a 10-year Treasury at 0.61%.
It's not attractive.
That's not good for you. You know what is pretty interesting? I've got a rate sheet in front of me. AAA munis right now at 2.4% on a 10-year. That's not so bad. But, when you sit and think about that even, inflation in March, according to CPI, was 1.5%. You're still barely positive. But, Dr. Gene, that's been the way that our yield curve has worked for quite a while.
Troy, I hate to catch you off guard, but do you have the rate on the ones that are inflation adjusted?
No, I don't have that in front of me. No, I got Treasury zeros, if that's what you're wanting to see.
No, isn't there a Treasury out there that guarantees you percent above the inflation rate?
Yeah, they do have those, but I don't have that in front of me.
Because that might be a negative interest rate.
It very well could be. It's supposed to adjust, and I think it does it on a monthly basis. So even if it is at the moment, you still should have a rate it's going to be slightly positive, but not very much.
Yeah, I would think so. Yeah.
Yeah.
Yeah. 10-year Treasuries at 0.6 is hard to justify. For anybody who's at least bit risk tolerance, and for people who have plenty of liquidity, I don't have all their needs for 10 years and just are piling up cash. I still got to tell you, something like our equity income portfolio. I mean, that's
right.
That's where I'd be putting my money. That's where I am putting my money. So It's not like I'm talking out of turn here.
Yeah, so Dr. Gene's talking about a portfolio of stocks that actually pay a dividend. Obviously, they fluctuate in price as stock market goes up and down. Our particular choice in that has, we try to get a well-diversified portfolio where we have exposure to every sector. I think at the moment we don't hold anything in IT, but information technology, it's just hard to find a company that pays a reasonable dividend. But that portfolio at the moment has got a yield that's still right around 4%, and that's while it's holding some oil stocks, some energy companies that are paying dividends over 9%. Now,
those are questionable. That's the reason they're so high.
Exactly.
Sometimes that's a sign to worry, isn't it, Troy?
It is, and to be honest with you, I do worry about those. It's something that me and my research team have been watching very closely over the last month or two. As oil prices are low, it means that their profitability is going to be squeezed, and we watch very closely for whether or not their earnings are significant enough to pay that dividend out at some point in the future. So we watch them closely, but like I say, a 4% yield on an equity portfolio. And oh, by the way, if interest rates stay low, which I would have to think that our government will want so that they can continue to service the debt that they've just amassed, they don't drive the market in any means, but they do set the cornerstone to many of the market's indications. But, all things considered, while fixed income rates continue lower, I would imagine that even if they fell further, you're going to have the benefits of a price increase on those equities and continue to
over any period of time. It just makes a lot of sense. But again, this is money that you don't need for 10 years. I'll make that clear. I'm not suggesting that money you need in your 10th year should be in stocks. I still think, in spite of the horrible returns, you need to protect yourself, and psychologically, it's helpful.
Right. Yeah. You avoid the volatility of equity markets, especially at times like this. But we try to keep our clients always in that situation where if volatility arises, and let's face it, February 1st, did anybody see this coming? I'd say no.